Okay, I think we're in a good place. So again, welcome everybody. It's Sandra Marcus speaking. Thanks for joining us. Happy New Year. I was just chatting with Michael, and we've decided that it is perfectly fine to wish folks Happy New Year through the month of January. So there you go. And with that, I'm introducing Michael Dominguez, who really needs hello from cold Connecticut. Yes, thank you. Cold up and down the East Coast. I'm introducing Michael Dominguez, who really doesn't need any kind of further introduction. So, Michael, take it away, and I'm going to go off camera, so it's all yours.
All righty, Sandra, thank you. And
Pleasure.
to everybody, as Sandra said, Happy New Year, because I am a believer that we can still do that and give you a great New Year's wish. So I'm going to go ahead and get started. I have some of the latest information we've seen on our industry, and overall, the one thing I will share is that overall, from an economic perspective and from an industry perspective, things are still looking pretty good. And of course, there's always going to be some headwinds. Probably the biggest thing we've seen in CEO surveys and other considerations has to do with geopolitical concerns, but not necessarily economic concerns. And I think that's a big shift for us. Not a lot of talk about recession, more of a talk of a soft landing or somewhere in between. And again, that should be really positive news. But I'm going to go ahead and start with a global perspective because I do think that's very important. And the one thing I wanted to point out is I'm not as stuck on the number as I am the direction that we are seeing. And what you'll see is that our growth projections from the International Monetary Fund for a global economy, advanced economy, emerging markets, developing economies, they're all going north. Nowhere in these do you see them going negative or going backwards, and that's a real positive for everybody. That's telling us globally the view and the perspective is rather healthy, and this breaks it down by region, and you can see that the United States has been rather steady across the board. The Eurozone is probably facing the greatest headwinds, but even with that, the expectation would have been the Eurozone would have expected some type of a recession or experience some type of a recession this year, and it didn't happen. And what you'll see is we see positive growth across the globe, and that gives me great hope that there's nothing on the horizon. And the one thing I think that is solid in that is the one KPI that is common in all recession periods is high unemployment. And you'll see on this left-hand side, whether it's the US or the Eurozone, Brazil, Russia, China, India, we just don't see spikes in unemployment. There's nothing. China has probably the highest spike, but it's not dramatic. Everybody else is either declining in unemployment rates or staying rather steady. And that's just telling us things are in a pretty sustainable position for us globally. You can see this is the latest McKinsey survey of economic conditions for 2023, and the biggest risk to the global economic growth over the next 12 months of all of their respondents is geopolitical instability. And you can see it's well over 60%. But what's important is slowdown in China is dropped dramatically. Inflation is dropping and continuing to drop. The biggest concern is what's going to happen around the world. We have conflicts going around the world. We have trade tensions going around the world. All of that's going to settle to tell us exactly what we're looking at and what that experience will look like. When we look at overall consumer confidence, overall it declined globally, but what you will see is the U.S. is the strength of that. When you look at this, the U.S. Consumer confidence is actually holding pretty strong, and our consumers continue to be resilient. We saw retail numbers today, if you were watching the market, that actually said that the consumer continues to spend on retail, and the retail numbers are continuing to be a surprise. Consumer inflation, here's another one, trajectory, all headed the right way. Everybody is coming down. The U.S. and the U.K. has had a small uptick in the core inflation number, and the only important thing there is that's going to dictate, if we do not continue to see a southern trajectory, that's going to dictate when the Fed actually starts to lower interest rates. So that's the only indicator. We don't see anything that's saying that inflation is going to spike, but it's kind of stubborn right now and kind of sticking where it's at. And you can see in different emerging economies, we are seeing inflation starting to resurge, specifically in Russia for a variety of reasons, but also Brazil. So other parts of the emerging economies, we're seeing that in inflationary spikes. We're not seeing that in advanced economies. So that should hold well for us from a micro perspective, even though that's a macro perspective overall. Wanted to point out the UK and look at the UK economy, and this is from Goldman Sachs and some of their research. You know, the UK has some of the greatest headwinds of anybody out there, and what's surprising was the UK and the Euro area are almost in line, and the US you can see is a large gap above that. So the US has performed really well as far as gross domestic product, but the UK and the EU, the UK is actually a surprise with their performance, but they're almost matching the European Union at the moment. Core inflation I mentioned was easing, but you can see this gives you a better visual where you get that spike in the UK and that spike in the US. But the labor markets have really started to rebalance in both areas, and that's important because one, that is going to continue to pull down wage growth, but more importantly, that's telling us that we're starting to line up with jobs that are available and people available to hire, and those are more and more coming in line across the world. You can see we had these large gaps because you want to be closer to zero. We had these large gaps specifically in early 2021. Moving over to the Eurozone, regardless of which monetary engine we want to look at, whether it's the IMF, the ECB, the OECD, they're all pretty much in line with looking at forecasts and gross domestic product forecasts for the Eurozone. And you can see the large drop off in 23 and 24. The takeaway here is that Europe is going to be much more stagnant and slower in GDP growth than the US and other parts of the world. And that has a lot to do with high inflation, high wages, and a little bit slower growth pattern that we're seeing there. So that's going to be the headwind. If there's any headwind, it's that. But the positive is that you don't see any of the projections going negative. They're just slowing down their rate of growth. And this is showing you the Eurozone, you know, between core and headline inflation. I think it's a good reminder. The differential between core and headline is very simple. Core inflation is a measurement stripping out energy and food, while headline inflation includes energy and food. So in the Eurozone, you can see a little bit of a spike in January in the headline inflation, even though core inflation is continuing to come down. That is really due to energy starting to pop a little bit, getting towards winter, and that has a lot to do with gas and the utilization of gas. If there's any headwind I'm worried about, it is what is happening in the Mediterranean Sea. We have conflicts going on, and I know you're probably familiar with it, but just outside of Yemen, you can see these yellow spots represent the number of trade vessels that have been attacked as they come through the strait. That is a challenge. The U.S. now is taking down drones. The U.S. actually, in coordination with the U.K., actually had some attacks on some terrorist sites, and this is picking up tension in this region. The reason this matters, and most of us don't pay attention, this is going to matter very much to supply chain issues and things that had started to normalize. This long term could create cost pressures, which would push inflation once again, and create some supply issues, which would push inflation once again. Right now, we're not there yet, but it's an important area, and an important area that we don't pay much attention to. And this kind of shows you global shipping numbers from around the world, and you can see there's a lot of traffic that is coming through that canal, and that's where this is definitely top of mind for everybody. You know, we talk about the Panama Canal often, but you can see the differential between the Panama Canal and some of these straits and how important it is to the global supply chain. So something to just keep on the radar. I don't think we've covered it enough. It's kind of like a sideline news instead of a headline news, and I do think it needs to be a little more in the headline. And this was an article in Bloomberg that can show you that shipping costs show signs of panic as this continues to be an issue. And costs are slowly starting to move up. And again, supply chains could be restricted long term. So it's something that I'll continue to report out on. And hopefully by the time we gather next time, this is a much more stable situation. Moving to the United States, wanted to talk about our industry. And this is the latest from CBRE. And you can see that occupancy fell further in November, but ADR growth is still positive. And this isn't a surprise. And I'm going to talk to this a little bit more because there's a little bit of nuance in the numbers that I think is really important, specifically if you're looking at this from the meetings and events perspective. November RevPAR, and again, RevPAR in its simplest terms is rooms revenue, fell as 1.2% ADR gain, did not offset the occupancy decline. So you can see that occupancy is declining slightly in November. And even though our average daily rate was up, it wasn't up enough to offset the rate decline. So right now you can see in the left-hand side of this chart, when you look at the 115%, that is the average daily rate is 15% higher than 2019. That's the way to read that. And then if you look at RevPAR, it's 9% higher than 2019. And then US occupancy is only at 95% of 2019. And remember, international has not come back fully. So probably not a surprise that that's where we're at. The spread between real and nominal RevPAR has widened. The reason this matters is when we look at real numbers and we look at, if we look at real RevPAR and nominal RevPAR, the separation is very simple. Nominal RevPAR is the number that we're seeing today, while real RevPAR is that same number, that same dollar number, but now literally factoring in inflation. And when you factor in inflation, you can see that the real RevPAR is only at 91% of 2019, which means the industry still has a little bit of room for recovery when it's all said and done. The performance of independents continues to normalize, and it's probably not a surprise of the independents and the chains. Many of the independents are in resort communities, and those resort and metro communities are starting to line up. So we're seeing some normalization in those numbers. And resorts continue to decline, but urban locations are increasing as trends converge. And what that just means is that the metro areas are starting to line up, specifically in the luxury set. In the luxury set, the urban markets and the resort markets have now lined up almost equitably, and that's given us some normalcy, and that is slowing down rate growth in those markets. So that is a positive for all of us when we start to look at that urban is now starting to normalize, and the resort area is starting to normalize as well. When I said there's some noise in the numbers, I really wanted to highlight the areas that are decreasing in our industry are the economy, mid-scale, and upper mid-scale. These are limited service hotels. And the reason that matters is they make up such a large majority of our overall hotel inventory in this country that they're dragging down the overall number and the overall average. But I think it's important that when you look at luxury and upper upscale, you know, that their RevPAR growth is still strong. And not only strong, if that's the RevPAR number, it's not being driven by occupancy, which I showed, it's really being driven by rate. So rate growth is still stronger in the luxury and upper upscale markets. And this is where you place most of your meetings and events. But what I was pointing to is all US in November, you can see dropped, but that really had a lot to do with the mid-scale and economy segments starting to drop at the same time. This goes back to what I was showing you or I mentioned about luxury demand. And when you look at this chart, the top blue line represents luxury resort demand. And you can see that it was pacing well ahead since January 2021, large separation between luxury resort demand and luxury metro or urban location demand. What you're seeing right now is those two lines have almost converged, which means we've normalized luxury resort and luxury urban now on par across the board. And the reason that's important, what you'll see is what that did to rates. When the resorts were well outpacing the urban areas, you can see rate growth was much stronger than we are seeing right now, and rate growth is starting to slow down. So that normalization is important from the rate growth perspective. And I know that's important to everyone on this call. The other highlight I think is important to highlight is, when we look at this recovery of this cycle, sometimes we tend to talk in older narratives, and you can see that this dark maroon, that maroon is telling you that during this cycle, we dropped almost 75% in year-over-year RevPAR performance from a hotel perspective. But what was important is we recovered to 2019, to pre-pandemic levels in 9 quarters. So that means in 2 years and 1 quarter, we actually recovered. And if you look at the great financial crisis, that yellow line, it was long and wide, and it took us 17 quarters, almost twice as long to recover from the Great Recession than it took us to recover from the pandemic. And I think that's important because sometimes the narrative was like we were still recovering while the industry as a whole had recovered in nominal numbers, not real dollars, by the way. And then this is from Symphony and Tourism Economics, and this was one of their latest reports. And where I'm really encouraged, as you can see, that this was a survey of planners through North Star Media and CVent. And you can see that more optimistic and no change of the planners. It's almost 90% of planners are in a no change or more optimistic, while only 11% are less optimistic. So that's the lowest, less optimistic we've had in over a couple of years. So we're feeling really good. And I always say, as people feel is how people act. So that's very much a positive for us. Morgan Stanley just came out from their survey and reported that they're looking at an 8% average year-over-year increase in organizational budgets. My whole point is, no matter how I'm cutting this, we're seeing all KPIs pointing in that same direction of anywhere from a 5 to 8% rate growth across the board. And then if we look at the markets, they really are starting to stabilize. Coming through November, it's still about 50-50, although we have more markets contracting than expanding, but still almost half of all markets are still in an expansion mode, and 52% of all markets are in a contraction mode. Total operating revenues are in the single digits, but they're still positive, and you can see that we've been starting to maintain around this 3% average as a whole since May, and that is kind of normalizing our industry. That's what it used to look like pre-pandemic. And the one thing that is driving not only our industry, but driving our economy is small to medium businesses are the drivers. We've seen that with business travel. We are seeing that with all travel around the group space. And it's an important one. And we're seeing that specifically from an economic engine perspective. It's small to medium businesses that are driving this. And you can see those small to medium businesses, huge uptick on luxury, upper upscale, and upscale. And that is, and the reason that it says chains here, because that is really the easiest one to measure, but you're seeing a lot of movement going into that. Also, I think what's important to call out is that what is happening with Airbnb is now pulled. It started in New York, but globally they've pulled almost 60,000 listings. The reason I point this out, that contracts the market even further. That makes the market even tighter while we have high demand as a whole. So still an important piece of the project, or an important piece of the puzzle. 2024 U.S. forecast, we're finally seeing an 8% increase in project construction. Very much a positive for us. Wanted to point out, if you go back to 22, we were down 5% in construction. If you go to the far right-hand side in percent change, we were down 5% in construction. We were down 4% in under contract. And if you go to 2023, we were down 1% in construction, and that's off the 2022 numbers. So under contract is growing. That's the 8%. So we're now starting to see that construction take off just a little bit. The challenge will still remain when you look at all projects. There's less than 60,000 rooms that are being introduced to a market that has 5.7 million, but that's 5,700 new construction projects. The majority of these construction projects are still limited service hotels, and that means non-meeting space hotels being built. That's probably the biggest takeaway that I think needs to be told in the story. And then unfortunately, this is the point. Select service continues to lead our construction channel, as you can see. Very small in the number of rooms under construction in luxury, very small in upper upscale. The rest of it is quite large in the upscale, upper mid-scale, and economy. So again, it's almost 70% of all construction is falling into the limited service area, which means we don't have a lot of relief for new meeting space. If you look at what's happening with the Fed fund rate and what's happening with new loans, that Fed's fund rate you can see has kind of petered out, and we're in that 5.4% Fed fund rate. What you'll see is underneath that, it's showing the number of new loan originations for commercial real estate around hotels, and it's just not happening. It's slowing down. We don't expect that to start picking up until that rate starts to come down, because money is as expensive as it's been in some time. And you can see that higher for longer interest rates are impacting the pipeline, because you can see the in construction, it's actually declined just a little bit from 22 to 23. 24 again looks better than that. Planning is down just a bit. Final planning is up, but that means it was already in planning before interest rates started to move that way. And under contract is slightly up, but that doesn't mean they've executed on anything yet. So right now, that is not, we're not seeing this tremendous growth. We think it will take off as soon as interest rates start to move. That's the point here. Here's a positive. When we look at special servicing, it means that banks are having to negotiate with some of these hotel loans to make it work for ownership. The special servicing has flatlined. We're at 7.1%. So in that regard, very much a positive. And then you couple this, it's expensive to build, it's expensive to borrow. And then you look at construction wages are up, continuing to grow dramatically. Construction inputs are up, which means iron and steel, lumber and woods, they're up well above their long run averages. It's just telling me we're going to have a compressed market for a period of time. We're not going to see that growth as soon as the rates start coming down. I think we're headed for an explosion of new construction once those rates get in line. There's a lot of eagerness and a lot of money sitting on the sidelines, and I think you'll see a lot of movement in that. My best guess would be starting late next year and moving into the first 6 months of 2025. When we look at the U.S. economy, the inflation number is a little bit sticky at this moment. I just wanted to point out this chart from McKinsey tells you what's building inflation, and this black is the important part, because that black is telling you that it's services, which means labor, that is the stickier part of that inflation, and that's going to remain sticky for a while. It doesn't mean we're not headed the right direction. We're just not going to be declining as quickly as we had been. And then other pieces of the puzzle that continue to move, specifically here in the U.S., is we're now trading trade partners, and we're looking at a different type of trade partners. You can see that Mexico has become the U.S.'s largest trading partner, while China, which is this light green on this chart, is continuing to decline. So very much changing the way the world is built. Jamie Dimon, I heard him again today from Davos at the World Economic Forum, and he's cautious but optimistic. And the one thing he's talked about is that the economy's been on a sugar high, as the way he references it, from the stimulus money that we had. And I've reported that out in the past, that it's the excess savings that we've now gone through. And we're trying to figure out exactly what that's going to look like as things start to balance out as they are now. I'd be remiss if I didn't talk about the markets, and I think it's important when we look at the stock markets. Yes, 2024, there's been a little bit of a correction of the takeoff we had at the end of 23. It's pretty balanced. But I think it's important to really understand, we now continue to talk about, and you'll hear about it, is the Magnificent Seven. The Magnificent Seven are literally driven by these 7 stocks that really outweigh the index. And it's important to understand that, because it's important to know on how we end up splitting this across the board when you look at weighting activities. So you can see that the Magnificent Seven had an almost 80% cumulative return in the index, while 493 other S&P companies in the S&P 500 only returned at 17%. So that is the differential, and it's an important one to keep in mind because it is overweighted. The Magnificent Seven represent almost 30% of the index stock across the board. And you can see that the Magnificent Seven, if you look at their returns, well outpacing the remaining 493 companies in the S&P 500. And then this one is a chart that I think is just really telling. When you look at the MSCI All Country World Index, if you look at Japan, France, China, UK, and companies based in those countries on the index, it shows you those four countries, all of those companies only weight to 15% of the MSCI, while the Magnificent Seven weight almost 18% of the MSCI, which means the Magnificent Seven outweigh four countries' contributions to the index. So it's an important one because I think there's nuance in all the numbers that we're seeing. And we tend to talk in generalizations instead of really understanding that there's noise underneath the headline. And it's important to understand that because these seven companies are not indicative of what a general economy is doing. These seven companies are just indicative of their markets and their strength in the markets. But probably not a surprise that the S&P 500, if you look at now versus their median since 1999, the tech and the consumer discretionary well outpacing any of the indexes we've seen, the average index we've seen dating back to 1999. But you can see almost every single category is doing that until we get to communication services and energy. Every other area is literally outpacing the median index since 1999. This goes back to what I said earlier, tells me that we have a pretty healthy economy, and it makes me a little bit bullish for us moving forward. And you can see that this is looking forward if we're taking some guess on what that's going to look like if you invested $1,000 now. How much would you have in 10 years' time? The biggest point is that the trajectories continue to move upwards. Nothing is going backwards, and that's very much a positive. And when I talk about the markets from a consumer perspective, because we look at the consumer health, their mindset, and what that looks like, the important part to me is taking a look that 60% of all consumers have some type of investment in the market, which means the markets matter. And the markets matter to how we feel. The markets matter to how we see our wealth. And the markets matter, most importantly, in how we spend. So that is why I kind of separate that and take it from that perspective. The market lives like a divided government. Most likely, we see a lot of volatility preceding the elections and relief rally as we get the results. And I think this is important. This is from Babylon Wealth Management. And it's just saying we like divided government. We have divided government right now. We know we have an election. But one of the things I would mention is almost 49% of the world population will have an election this year. So it's not just the US, there's elections around the globe. That means we have a little bit of a reset and reshuffling of leadership around the globe. And those are part of those geopolitical instabilities that we're not nervous about, but we're definitely keeping an eye on. If we look at the US dollar, and on this chart, it would be really looking at the right side of this chart. If you look at the US dollar versus change in currency value since 2007, the US dollar is up 30%, while all other base currencies based on the dollar have declined dramatically, as you can see. That shows the strength of our dollar. We've sometimes continued to read about the death of the dollar. The dollar is still strong, and you can see still outperforming all other world currencies across the board. So gives us some hope, at least in the short term, that things are still going to be rather strong for us. As far as what's happening in the job markets, you can see there's now a thought process that the job markets can stay strong. And again, we have never had a recession with a strong job market. It is high unemployment that traditionally leads to that. When we look at what's happening in private payrolls, you can see that they're remaining flat, but they're not declining. So we're still hiring people on a monthly basis. And you can see that overall hourly earnings are starting to increase again, a little bit of a pop. So we're not seeing any decline in earning increase. We're not seeing any decline in hiring, as far as that's all still on a positive. And most importantly, you can see that the average hourly earnings increased 5.7% last month on a year-over-year index, and you can see, or from a year earlier, and you can see the consumer prices have continued to come down. So this just means even increases in wages are outpacing inflation, and that should be very good for a consumer across the board. When we reel this back into the leisure and hospitality segment, we now have 16.8 million people employed in our industry and 16.9 million people previously. So we're within 100,000 or so of getting there. We continue to increase labor in our industry, as you can see, on an average of 3.3%. So it's been very, very healthy. And the one thing I would point out is this chart on the left shows you monthly job openings per hotel in the United States, and that number is 19. Now, that number may seem large, but before the pandemic, that number was 18. So we're within one job opening per hotel of where we were pre-pandemic. So that's telling us we've pretty much right-sized. I always say we tend to deal with old narratives, and the narrative right now is we're getting closer to that norm. But you will see on the right-hand side, between 2020 and 2023, hospitality wages changed by or increased by 7.7%, while between 2017 and 2020, they only increased by 4.1%. So that's the difference between a 12% increase in wages over a 3-year window and a 24% increase in wages over a 3-year window. And that's a little bit of the cost pressure hotels are feeling because wages have continued to increase, and that's nothing that's going backwards. That leads into, when you look at this chart, again, we're still reporting out when you look at this red box. If you look at gross operating profit margin versus monthly change year over year, you can see we've been declining in our industry since February. September was the only month we didn't decline, but outside of that, every other month we have declined since then. And then this just shows you pure gross operating profit dollars have decreased between April and October, except for September. September is the only month that we saw that uptick. Even though October is relatively flat, it was still negative, but it's just not showing a lot of profit growth. And that really has a lot to do with labor overall. One of the things I wanted to put just on the radar is I think it's important to pay attention to the OpenAI lawsuit that is taking place by the New York Times in their filing of their suit, and it's really looking at proprietary information. It'll be interesting on how this resolved and what comes out of it. I think we'll start to dictate other conversations around AI and OpenAI specifically. I also wanted to show some overall sourcing data that we had received from Cvent, which I thought was really positive. And this really shows you how the narratives have changed just a bit and what we're seeing. But you can see since basically Q3 of 2022, room nights performance against 2019 in the United States has been a positive in the group market. And again, the average booking window, one of the things we've consistently heard is that the booking window is so much shorter, so much shorter, so much shorter. What we're seeing is right now, the booking window is almost exactly where it was back in 2019. So we see a 2% increase in the year, in the year for the year. That is not dramatic, and that was in 2023. 1 year out, 38%. And then you can see that except for 3 years and beyond, it is the only place we really haven't seen or that we've seen a change. Everything else is kind of in line. And if you look at it by size, that kind of stays in line. Not a surprise that we're a little bit lower in that booking window on the 201 plus, and that has to do with looking further out. But I thought this was fascinating because we know there's been a lot of new players, specifically on the hotel side, and a lot of new employees on the sales side. What you will see here is 54% of all planner organizations sourced for the first time in 2023. So you have 54% new organizations. But what's interesting is if you look at the 46% of the organizations that have always sourced through Cvent, 33% of those planners are new. And that means we have a lot of new planners that are in their roles, just like we see on the hotel side. And candidly, I think that's putting a little bit of friction in the road as we have a lot of people to assimilate into their jobs. And then this shows you sourcing to and sourcing from. So sourcing from is going down the left-hand axis, and sourcing to is on the right-hand axis. What it will show you is that 40%, the largest being sourced to is the Southeast, and it's being sourced by the Southeast to the Southeast. And that's the way to read that. But that is number one. The Southwest is the Western US is the second largest sourcing to. And again, it's being sourced from the Western regions. So it's probably not a surprise that regions within regions is where that business comes from. And we're seeing that consistently across the board. The other thing we've consistently heard is that planners are looking at so many different destinations when they're submitting an RFP and searching with an RFP. And what you're finding is 75% of all RFPs are sourced to a single metro area. And again, that's not lining up with the narrative, but that's what the data tells us. Now, when you don't find availability, I'm sure we go look at others, but the initial sourcing of an RFP is a singular destination almost 75% of the time. Food and beverage, trend lines from McKinsey through through the end of the year are showing us that we're still declining the right way. We're all headed in a negative trajectory. Everything is headed down. Sugar is that little uptick that you see on the bottom. But the one thing to point out is even though we've been headed down in food and beverage, we are well elevated to previous years, and that's very much a positive. Olive oil prices have doubled over the past year. It's something that's just kind of off our radar and we don't think about, but you can see this large spike, and that has a lot to do with the droughts that we've seen in the Mediterranean. Spain is one of the largest olive oil producers in the EU, but these spikes in olive oil pricing and this drop in crops has really put a strain on the olive oil supply globally. So that continues to be stressed. As certain products go down, certain items go up, and this is just a great indicator of that happening and what that looks like. Here's some positive news. The consumers is still optimistic. We're seeing that across the board. They keep spending. That goes back to my original comment about the retail numbers being positive, but you can see that between restaurants and groceries, still a positive trend line. It's electronics, pretty much flat, and then jewelry is the only thing that decreased in the consumer spending. But consumers are spending on travel, and they are continuing to look at travel as something that they are making up for from the pandemic timeframe. Corporate brands average search index is up 5%. Brand loyalty programs are up 2%. It's telling us there's a lot of visibility in that market. And considering we're seeing fixed mortgage rates starting to come down, we think the housing market will start to pick up speed. I heard that this morning on CNBC. There was a little bit of surprise in those numbers as well. And I think that's a real positive. Also positive for our economy is this is from Gallup, and you can see that the institutions Americans trust the most and the least. Here's the positive is small businesses are number one. And small businesses, as I've shown in past presentations, have been where our growth is. So this is very much a positive. A sad statement on this chart, if you go all the way to the bottom, is Congress scores the worst as far as most trusted institutions. As far as air travel, TSA throughput is still setting all kinds of records and up to 2019. Outbound international travel has fully recovered, but inbound hasn't. And when you look at this chart going outbound, it is still the Caribbean at 129% that is the driver. When you look at inbound overseas travel, that inbound, we are still dragging, and Asia is the biggest laggard at only 69% recovered at this point. And this will show you the total inbound and outbound and the difference between the two. We need that differential to tighten. That'll also tighten up occupancy. But so for us to be performing where we're at with this still absent is actually, to me, a testament to how strong the rest of the industry is. And we do expect this to rebound. It's just rebounding at a slower pace. Excuse me. Travelers from China and Japan, they hit a post-pandemic high of 53%. That is the traffic. And remember, the main reason for that traffic to be lagging is their zero COVID policy put them into restrictions much longer, very much like we saw in the US and in Europe. people traveled domestically first and then moved internationally. And we're seeing that in China's numbers. We're seeing it in Japanese numbers. So we would expect, specifically in 24, I'm expecting this to be a much stronger recovery across the board. The reason that matters, we have two different ports of entry. You can see that the Northeast port of entry is at 86% recovery to 2019, and then the West Coast is only 72%. Why was the West Coast so much lower? Asia would be traveling through the West Coast, not through the East Coast. But our international travel and international tourists, you know, even in North America, you can see all of it is heading the right direction, which means we're continuing to see growth. We're continuing to see international traffic, and we do expect that to normalize within the next 12 to 18 months. Airlines, we all know the issues, and I know you've been well aware of it in reading about the MAX 9s. Know that that impacts the most flights with United Airlines and Alaska only. Those are the two airlines, US airlines, that have MAX 9 planes that are flying. So that is a small impact on that inventory. It is not impacting the Deltas of the world, the Americans of the world, the Southwest of the world. The Southwest airlines, they actually fly the MAX 8s, not the MAX 9s. It's the MAX 9s that we're having the issues. So an important distinction to be able to separate those. And I will stop there, and Sandra, and open it up for any questions we may have.
Back. Okay, anybody with questions, you can put them in the little Q&A function in Zoom. Mine, I find on the bottom of my screen, it looks like two conversation bubbles. So have at it. And while you all pose your questions there, I will vamp for a minute and see if I can make sense of my notes. And they're not in any particular order.
Okay.
One thing that you shared, if I got the statistic right, really surprised me, and I think it came from Morgan Stanley, an 8% increase in travel budget.
Corporate travel budgets,
Corporate travel budget, sorry, not just their travel budget,
Yeah.
which was what I meant broadly.
Yes.
But,
Yep. That's
I'm
correct.
so surprised by that.
Yeah, you know what's funny, Sandra, is that when I prepare for anything like this, I'm always trying to find something to counter what I'm seeing. And the point is, it doesn't matter if it's Morgan Stanley, it doesn't matter if it's American Express, it doesn't matter if it's STR. We're getting into the same range. Everybody's kind of hitting that same pocket, and it's anywhere between the 6 to 8% range that we're seeing across the board. And those are the budget increases. When I think about just overall inflationary, pressures, that's 3.5 to 4% of it. So it's only a 4% increase above that, when it's all done. But to your point, you've heard the narrative that corporate budgets are flat. Nobody's getting increases. Yet we're not seeing that in the analysis. Now, overall, I don't know what that means, because is it because your budget per person is flat, but we're adding more people? Could be. And that could still be the increase in the overall budget. Or how are they surveying it is always my question. Because to your point, and I love the way you referenced it, because the overall corporate budget, if you separate air, that may not look the same way. If you separate events, it may look different. But when you roll it all up, the overall corporate budgets are increasing. And I'll tell you, my read on that is, I think that overall number is increasing because specifically in last year, we hadn't normalized business travel. And I think you have some of those companies having business travel come back, which means my overall corporate budget is increasing if I'm putting people on the road. Does that make sense?
It does. It does make sense. And I'm glad we got the added context there.
Yeah.
So my next one, and again, everybody feel free, Q&A, easy. Let me just make sure I'm not ignoring you. No, I'm not ignoring anybody. Let me see if, like I said, let me see if I can make sense of my notes. So I think that I heard slight declines in hotel room occupancy.
Correct.
not that I travel all that much, but I think others, if they could open their microphones, would agree. There's hardly a city you can fly into where you don't see a sea of cranes. And you talked about construction and gave us lots of detail about what's being constructed.
Yep.
So where I was headed before today's meeting was to ask you a question about, are we, and forgive me for not looking at you because I'm looking at my notes.
No problem.
Are we headed toward a tipping point where it would be a buyer's market where we won't all be scrambling either because our lead time to find space and rooms is insufficient, or the funds with which we have to work aren't mapping to what's available? I know that there's lots of factors that come into play, but when I think about what feels like this just wealth of room and space, it always surprises me that demand outpaces that.
It does. It does. And the short answer, in my opinion, would be no.
Mhm.
We're not at a tipping point. You're not going to see it. And the reason for that is, and I showed this chart in our last session, was if you look at historical supply leading into this cycle, we're down almost 50% versus most recovery cycles. If we would have been building over the last 6 to 7 years at the same pace, I would be answering yes. The answer would be no right now, because there is now. It's also, I love that you point this out. November occupancy was down. That doesn't mean overall occupancy is declining.
Mhm.
That was a month by month. And calendars get a little funky because if you remember November, Thanksgiving was later this year. It has a funky calendar, so it throws some of that noise into the number. But when you're looking at a yearly number, we're kind of flat. We're not growing in occupancy, but we're flat at within 1.5 points of the all-time record of occupancy in the United States. And
Wow.
that's with new inventory. So when you look at that, it's like, no, we're factoring that. And we don't have enough supply coming in. And the one thing I can't stress enough, and this has been consistent over the last 5 years, almost 75% of everything we've built is limited service. It's a Hampton Inn, a Hilton Garden, a Courtyard by Marriott, which means it'll help you with citywide rooms, but that's not going to help you at all with meeting space if you need that.
Right.
And I think you're going to have more compression. When you think about, let's take the Austins of the world that are expanding their center, but having to take their center out for certain pieces, you've contracted a market when we're already tight in certain areas. And they're one example of 20 where people are adding space and having to disrupt what they would have normally had as far as patterns as they continue to build on. And what we usually find, Sandra, with most of the convention center ads, it doesn't necessarily mean there's this dramatic increase of larger groups. It just allows them, with load in and load outs, the flexibility to stay more consistent without these big pockets that they have. So, overall, I don't see anything. And the one thing I was trying to point out, now take the fact that you've lost 60,000 Airbnb listings globally. In New York, it's 18,000 alone. That's compressing the market even tighter, because that is inventory that can't be used even by a business traveler or somebody else that will now be in a hotel, which brings up that occupancy. And what I was trying to point out, we do see the steady increase in international. So we're almost at the record with international being almost 30% down.
Yeah, right. Still. Mhm.
So when they come back, I just think that's why the demand is still going to be there.
So let's go for a minute longer. Oh, hang on one second. Let's not hear from me. Let's hear from somebody else. Bear with me. Let me read this and then see if I can paraphrase. Hearing from I had this on my list. Wonderful. What are you hearing from the industry as far as events taking, I think they meant to include the word place, taking place in the Gulf region with the ongoing conflict? Are corporations operating business as usual, or are they going to start pulling back from areas such as the UAE that aren't directly part of the conflict, but certainly, right, those of us who live in the States think of that region as being, right, all things close together?
Yeah, it's an interesting statement because I was just in Dubai in December, and the interesting thing is you're not seeing any pullback from the region. Short answer. Now, it doesn't mean that there couldn't be in the future, but I think part of it is what you said, Sandra, that we're all Americans specifically, or U.S. We're really bad with geography to realize it looks like it's really right next to each other, and they're nowhere close from a conflict standpoint.
Mhm.
Now, caveat, should the conflicts spread more broadly, which is the fear and the concern, then that question to me would be, yeah, you're going to have people considering it just because of risk management with corporations. They're not going to take the chances.
Right. Uh,
But no, I was just saying, but currently we're not seeing it.
and I didn't mean to step on you, Michael.
No, you're
Sorry.
fine.
It, not risk management as far as travel goes specifically, but big corporations focus on risk management changed dramatically, right? Once the pandemic started, all things, right? Understanding how to contain and be prepared for whatever the potential conflict.
Exactly. Exactly.
My question was going to be a little different. That one was worded more clearly. So it came from anonymous. So whoever you are who asked that, thanks. I was going to ask what the I don't want to use the word trigger because that's so violent, what the catalyst would be for people, not the corporation setting policy, but for people to say, I'm reluctant to travel because of geopolitical tensions. But this was worded more, I think, more appropriately for our industry. So let me ask you one more, and then we'll wind down. Again, folks, plenty of time, 4 minutes. If you want to post a question in the Q&A. So we talked lots just now about occupancy and demand.
Right.
Occupancy, demand, inventory, everything that makes for, right, a healthy business for hotels, challenging sometimes for those of us who are planners or event marketers. So is there any relief in sight beyond rate? So services are expensive, labor is expensive, food and beverage is expensive.
Yeah.
Any relief in sight for the cost to deliver high quality and experiential meetings?
In a short answer, probably not.
Mm.
And the reason for that, number one expense to any hotel, any operator, is labor. And labor is not going back into the bottle. And I share with people, we are all celebrating as an industry, and I mean this truthfully, that we have housekeepers earning over $20 an hour. But that's one of the reasons costs will never go backwards, because they can't to operate. I showed that one slide. We're at record revenue, and yet my profitability is continuing to shrink year over year. And I have another slide. I thought I showed it last time, but if you look at it as a percentage of revenue into 2024, gross operating profit is shrinking as a percentage of revenue, but labor is increasing as a percentage of revenue, and that's why profit is shrinking. And it's going to be hard, but Sandra, there was an aha moment. We had our Alhai executive exchange, and I had a financial planner that asked the question. I was fortunate to have Jan Freitag from STR that was with us, and we were having a fireside chat after his presentation. And the question was like what you just presented. I'm paying more than I ever had. I don't feel like I'm getting more, but I'm paying more than I ever have. Is that going to change? And his response was telling, because we both jumped back in, and he said, you're paying more for an airline ticket and you're not getting more. And I jumped in and said, I don't know about you, but when I go to a restaurant, I'm paying more than I ever have, but I'm not getting more food. Yet there's this separation when we think about hotels that I think is important for our stakeholders to understand. Everything in our society has moved. And the one thing that I think is missed when we talk about inflation, our decline in inflation is not inflation or things getting cheaper. It is the rate of growth of inflation that is slowing down. So that's why I can answer your question confidently that it's not going backwards, because until we have deflationary pressures where pricing and product gets cheaper, it can't, because inflation is still there. And I think that's missed, Sandra, because the headlines keep talking about declining inflation. And I think people read that as things getting cheaper, and that's not the case. It's the rate of inflation growth is slowing down.
And the cost, this is a very broad sweeping statement, but the cost for a hotel to deliver what it is we all have expectation about receiving for us and for our clients, right? That's not going down either.
No,
So,
not at all. Not at all.
but maybe we were talking about flying a minute ago. We'll land this plane on sharing the narrative and story. Sharing that with our stakeholders is really important. It doesn't necessarily make a budget conversation go away,
Right.
but it helps, right, for folks to understand who don't walk these paths every day, why exceptional business events are costly.
Yeah. I there's one aha moment I had from a client. She told me this because it was in one of these sessions like that. But she had asked me, help me explain to a stakeholder. She goes, where would you have me start, Mike, when I'm saying what I should be asking for to increase a budget, for next year for my meeting or event? And the one thing I told her, and she said it was really helpful. I said, I would start with any of those stakeholders to say, what was our increase in our budget in revenue for the year coming up? Because whatever organization you have, whatever company you work for, you increased revenue to offset costs. And what I told her was, let's say that's 5%, then at least start there to say, why would you not expect that for me to run this program, there would at least be a 5% cost increase to offset the cost increase that we offset in our own budgets. She told me that was a really helpful starting point for some of her stakeholders, because it reminded them in their own business to say, yeah, I'm having to take up pricing to offset my increased labor, my raises, my insurance, everything that's gotten more expensive. And that was a good connection point for everyone on the call. I think that could be a helpful starting point.
That's great. I'm going to leave it there because I couldn't say it any better. Two things. One, Michael, actually three things. Michael,
Okay.
thank you. Everyone who joined us today, thanks for joining us. I hope that you walk away with a tidbit or two that you'll factor into your next conversation. And then lastly, last quarter's session with Michael and this session with Michael will be eligible for EIC credit, and you can find details about that on the SEMA website. And with that, we started with Happy New Year. We'll end with Happy New Year. Until next quarter, Michael, we'll see you then. Everybody else, thanks. And we'll talk to you during whatever our next SEMA event is.
Sandra, thank you. Thank you for all that SEMA's doing. Appreciate it.
Pleasure. Thank you.
Thank you.
Have
Bye-bye, guys.
a good rest of the day.